two Alexes, and Assaf. I think let's see. Did I? I think I messed up something here. Okay, I think I should be okay now. And with Assaf, I think some of my co-authors might be in the audience. I do not know, but if they are, well, thank you for coming also. So the title of the paper is "Cheap Options Are Expensive," and I'll tell you what the paper is and so on. But I have to kind of, I guess, warn you a little bit already that the title is a little bit cute. So, maybe too cute is what you might think, but you will see why I say that. So this is what the paper is basically going to be about. And what is it that we are going to find? We are going to show that options on low-priced stocks are overpriced relative to the options written on the high-priced stocks. That's going to be the bottom line. If you want to remember one thing from the paper, that's what we are going to show. Okay, we are going to show this using evidence from portfolio returns, Pharma, Macbeth regressions, and other stuff. I'm going to show you additional evidence from some kind of quasi-natural experiments also. And you know, so that I think we have fairly solid evidence of this empirical pattern that we are going to show. The question, of course, is, well, why do we see this pattern? Why is it that options on low price stocks, which is where the cuteness of the title, let's say, comes from? Cheap options are expensive, options are low priced stocks. Supposedly cheap options, they're actually not cheap, they're overpriced. So where does this overpricedness come from? Our claim, the story that we are selling in the paper, is that this option mispricing is driven by investors, some investors, not all the investors, but some investors' partial inattention to the underlying stock prices. We have a model. The paper is mostly empirical, so I will not go through the details of the model, but I'll give you a little bit of highlights of what the model is about. But here's the idea that we have behind the model, or behind our results. So we believe that in some of the investors who look at these options on low price stocks, because the options on low price stocks in general are also going to be lower priced, they might believe that these options are good deals. Why might they be paying, thinking that these options are good deals? They might not be paying full attention to the underlying price. So very roughly, vaguely speaking, in our model, we have investors who do not pay adequate attention, full attention to the underlying price, thereby contributing to the excess demand of these options, making them overpriced. Okay, that's going to be our story. As I said, in just the next slide, I'll walk you through a little bit more about what the model is, and then you will see. We don't explore a lot of other mechanisms, but there is one thing that we do explore, which is this preference for skewness that some people have talked about in relation to other asset classes, and sometimes even for options. And I'm going to show you some results that this preference for skewness is not going to explain the totality of our results. Okay, it might explain some parts of our results, but not the totality of our results. So that's basically what we are going to do. Now, very quickly, because I have right, so I have only like 50 minutes. That's what I was told. I was told that if I go over 50 minutes, they'll cut me off. So I have to kind of stay on track. We have a model section in the paper, which is to guide our empirical work. But I'll be frank with you. The main objective of our paper is empirical. But in any case, let me tell you a little bit about the model. I'm not going to spend any time on the derivations, etc. If you're interested, please look through the paper. What is the model? The model is, we are going to borrow from this pioneering paper of Garliano, Pedersen, and Pottishman. Is going to be a dynamic model of demand-based option pricing. It will have 3 tradable assets: a stock, a call option, and a risk-free asset. We are going to have 3 agents, right? In GPP, they basically have 2 kinds of investors: the market makers and investors who have an exogenous demand for whichever reason. we will have three kinds of investors: rational investors, and the main focus of our attention is going to be those limited attention investors. I'll tell you in like the next slide as to why is it we call them limited attention. These rational traders and LA traders are the end users who will demand options. Market makers will clear the markets and so on. The problem, as in GPP, is going to be that market makers cannot dynamically hedge costlessly. The presence of hedging costs is what's going to create the demand pressure, which is going to create a reason for options to be not basically the Black-Scholes price. So who are the main actors in our drama? These are the limited attention investors. Everybody else in our model observes the stock price, the underlying stock price precisely. In our model, we say that the LA agents, the limited attention agents, do not pay full attention to the underlying price. Okay, so it's just a framework for us to model the limited attention, right? So that's the goal that we have at the back of our mind. We want to model limited attention to the underlying price. The way we model the limited attention to the underlying prices, we say that these guys, these LA guys, they kind of observe, they know overall distribution of the stock prices and the economy of all the underlying assets. So if you want to put this in a Bayesian framework, they have a prior according to which the underlying stock prices are kind of determined. But these guys, they don't get to observe the stock price of each underlying themselves. But what they observe is a private signal about the stock price, which is the actual stock price plus some noise, etc. These guys are Bayesian. They update their posteriors of the stock price based on the usual Bayesian updating rule. But so here's the kick which comes in our model, right? So there's two things. First thing you might ask is, well, why is it that these guys do not observe the stock price? Well, it's a publicly available information. So what is it that's going wrong with these guys that they cannot observe the publicly available information? And while that's a good question, I think the answer that we have, or the story that we have in mind, is, well, there's a lot of stocks out there. There's lots of options there. So paying attention to all the cross-section of the stock prices and so on, which also change dynamically, might be too much of a mental effort for these people. So that's why these guys do not pay full attention to the stock prices. What happens then ultimately is, well, these guys, if you think about a stock, if you think about an underlying which is a low price, these guys, these limited attention guys, they believe that the stock price is not as low. So they're going to think that the options on these low priced stocks are going to be good deals. They're going to have, so in our framework, this is not going to be an exogenous demand, but this is going to be a demand driven by their inattention. They're going to have, everything else being equal, higher demand for options written on low price stocks. The rest of the stuff, it requires work. I'm not saying that it's very trivial, but then the rest of the thing kind of follows from Garleano, Pedersen, and Potashman. We do some additional stuff there and so on, but that's basically which creates this extra demand for options on the low price stocks and ultimately makes them more expensive. So the bottom line, the 3 or 4 hypotheses which come out, testable hypotheses which come out of our model, are that the options on low price stocks are overpriced and vice versa for the underpricing. This mispricing is actually asymmetric. In our model, the mispricing is going to be bigger for options on low price stocks. That's again a testable hypothesis. I will show you that we find evidence for that. And I guess not surprising that the mispricing is increasing in the number of these limited attention agents, their risk aversion parameter, and their degree of inattention. Again, it's a testable hypothesis that we can check, and I will check. Finally, because market makers, right? Market makers are the ones who are trying to do all this arbitrage. They cannot hedge perfectly. So if they could hedge perfectly, everything in the model goes away, just as in GPP. So the mispricing obviously depends also on the hedging costs, etc. So that's going to be the 4th hypothesis that I'm going to check. All right. So with that model out of the way, let me jump now directly into the data and the empirical analysis. The data are going to be standard option metrics, 1996 to 2020, 15 years of data. We are going to do standard filters. There's nothing fancy going on there. We are going to include options only with the moneyness between 0.8 and 1.2. Amongst those options, at the end of the whatever our trading period is, we are going to select only one call and one put for each stock. The one that we are going to select is the one closest to ATM. In our sample, obviously, then, if you look at the average moneyness of the options that we select is close to 1. We retain only options with standard maturity, third Friday of the month, and only 1 month to maturity options. So we are basically going to trade Friday to the third Friday, option expiration to option expiration. That's what's going to be our options. Those are the options that we are going to select and that we are going to trade. We are going to form delta hedged options, right? Because we obviously we want to study only the effect of the options, not the underlying and so on. So we are going to form delta hedged options using option matrix delta, hold them 10 expirations. One thing which might be important, well, which is a little bit important and you might wonder, but I will show you some results later, is we are going to do standard thing, compute option returns from quote midpoints, the midpoint of the bid and the ask. As you all know, having attended these workshops a lot, the option trading costs are very high. So this could have a significant or maybe an effect on our results. And I will show you in one table that it does have an effect. And if you have questions, we can talk about that later. But for most of the paper, I'm going to calculate option returns from the midpoint of the bid and the ask, right? So that's basically the data. Now, what is it that I'm going to do the first thing, right? So the model, in some sense, the key variable which is driving the option returns, again, is coming from limited attention investors and so on. But the key variable which is driving our results is the underlying price. It's not really the option price per se, it's the underlying price. So as a first natural check of our model, we are going to sort these options on the underlying stock price at expiration days, right? So like I said, we trade Friday to Friday. That's what we are going to do. So these are standard portfolio sorts. Decile 1 is the low priced stocks and decile 10 are the high priced stocks. Okay, that's what we have. Now in panel A, I have delta hedge calls. In panel B, I have delta hedge puts. Let's look at just the 7-factor alpha of these portfolio returns of these options. Alpha computed from, if I remember correctly, these are 5 Pharma fringe factors, momentum factor, and the zero beta straddle of Kowal and Shumway. Okay, this is what we basically find. So if you want to, the 10 minus 1, this is the long short portfolio of the delta hedge call returns, is positive. If I want to look at, for example, in decile 1, if you remember, is the decile of portfolios of options on low priced stocks. Our claim is these options are expensive, too expensive. If they are too expensive, we are expecting to see low negative alpha returns on this. That's exactly what we see. The alpha here is minus 67 basis points per month with a very high T statistic. So overall, if you look at the 10 minus 1, the 10 minus 1 return for delta hedge calls is about 58 basis points. If I look at delta hedge puts, that number is slightly smaller, but again, 34 basis points with a very high T stat. So at least the first look at the data is supportive of what our main hypothesis of the model is. I will probably not get to spend a lot of time on this, but if I also mentioned that one of the hypotheses of the model is that this effect of asymmetry, that this mispricing is different for decile 1 versus decile 10. And we kind of see that also that decile 10, although is a small number, this mispricing is smaller for decile 10 than it is for decile 1. Right? So that's the first check, the simple check that we have. Single portfolio sorts, that options, I think what I want you to kind of remember from this is that options on low priced stocks have low returns, which is our way of saying that they are too expensive when we buy them and we hold them to expiration. The returns are negative. The returns are negative. The alphas are negative. Now, one question that you might have, that we had is, well, when we are sorting on the underlying stock price, obviously the underlying stock price could be related to many things. For instance, it's quite clearly related to the market cap of the stocks. Maybe there is a relation of these returns to the market cap of the stocks. Maybe there is a relation of these option returns to the underlying volatility of the stocks. Volatility is different for low price stocks, etc., etc., etc. So we need to somehow control for these maybe confounding characteristics. So sorry, Dimitri had a question. Where's the story for why delta hedge returns on portfolio one differ for? Let me see if I can. I'm just going to try to get to the chat for why delta hedge returns on portfolio one differ for puts versus calls. You mean so the question I think is why is this minor? Oh, if I look at the alpha, why is this 67 basis points versus why this is only 39 basis points? I don't think I have an answer to that as to why so let me repeat the question, or whoever was asking, I don't know if it was Dimitri or somebody else. Why is it that we are seeing a stronger effect for calls than for puts? I don't have an answer right now, Dimitri. So I'll have to think of that. Thank you for asking, but I don't have an answer right now. Okay. All right. Okay. All right. So as I was saying, we need to control for these confounding characteristics. This is what we do. It's kind of a busy table. Let me explain kind of what we are doing. We are going to do double sorts. We are going to do double sorts. For example, if I look at the size here, I'm going to do a double sorts of 5 quintiles of size plus times 10 quintiles of the price. Okay, so the stock price times the size. I will have 50 portfolios. I'll average them across the size quintiles and so on, the standard stuff. And all I'm showing you here are the 10 minus 1 returns. Okay, actually I don't remember now. These are the returns or the alphas. I believe these are the alphas. Because alphas, what I had in the baseline was 58 basis points. When I control for these characteristics, you see that across the characteristics that we have chosen, the number remains pretty high. It's not always 58 basis points. Sometimes it gets reduced to 37, 38 basis points, but it's pretty high.
Can I jump in with a clarifying question? You may have said this and I may have just missed it. Is the 58 basis points per day or per month?
Per month. 58. Yes, this is 58 basis points per month.
Okay. So what's round numbers? What's the typical option price in portfolio one?
I will have to, let me see if I can find this quickly for you. I would think it's in pennies. I have this number somewhere. I'm looking somewhere. The option price in decile 1 is about 50 cents.
So sort of in dollars, the magnitude of the effect is 58 basis points on 50 cents?
Something like that. Correct. And these are delta hedge returns, right? So, yeah.
So it's less than a penny. 58 basis points of 50 cents.
I guess that's correct. Yes, half a percent. Correct.
Okay, correct. I'm sorry. I'll stop with this. I just wanted to clarify what the magnitudes and what the units were. But in
dollar terms, right? So in dollar terms, that's what your question was, Neil,
yes.
Right? In terms of dollars. Correct. So right. So these are going to be delta hedge. So yes, correct. So these are options, obviously, which have low prices. Let's say they're trading in less than $1. The options are trading on less than $1, and the 58 basis points, therefore, is going to be not a big number.
Oh, so let me ask another clarifying question.
Yeah.
Is it 58 basis points of the option price, or is it 58 basis points of the value of the delta hedged portfolio?
Value of the delta hedged portfolio.
Wow. Okay. What's the typical value of the delta hedge portfolio?
That I do not know. I do not recall at the top of my head. That okay. I do not recall. I do not recall. If you want to, I can kind of think of do this thing at the back of my mind, back of my head, right? So the delta of these options is going to be about half. These are ATM options. So that's going to be 6 times half, 3, I would say $2.50. Roughly, this is my back of the envelope calculation right now. On average, that's going to be the value of the delta hedged. For decile 1, we are trading about $2.50.
Okay, I've just chewed up too much time with a clarifying question, so
no, it's good.
I'll let you move on.
Good. Okay. All right, so that was in the single sorts. In the double sorts, like I said, it does not really matter amongst the characteristics that we have chosen. I'll come to one of them later, but I just want you to note that one of the characteristics that we use here is the skewness of the underlying returns. Okay, so if we control for that, actually it has really very little effect in terms of our portfolio returns. All right, so that's the double sorts, right? Okay, I just want to keep a track on the time. Okay, so that's the double sorts. As is usual, we will also look at Pharma Macbeth regressions. These are standard, again, Pharma Macbeth regressions, the left-hand side being delta hash calls or delta hash puts, and the right-hand side being lots of controls. I actually truncated the table here. There's other controls here which are not listed here in the slide, but we have controls for size, book to market, etc. We have controls for these kinds of characteristics. We have some option Greeks, etc. Our interest, of course, is in the coefficient on the log stock price, okay, which we find to be positive and highly statistically significant. Again, corroborating the evidence from the portfolio sorts that higher is the price, higher is the return. That means the options, if you want to think of this in terms of, again, my language that I used before, options on high priced stocks are underpriced, options on low priced stocks are overpriced, which gives us this positive coefficient on the log stock price in the Pharma Macbeth regressions, right? So in some sense, these regressions are a little better than the double sorts, because double sorts are just double sorts. And this, if you want to think of these as, these are multivariate sorts on lots of these characteristics, all controlling for all of that, we still find that log stock price has an important effect on these delta hash calls and delta hash put returns. Okay, so that's the Pharma Macbeth regression. Now, one thing we thought of was interesting, I don't know how you would feel about it, is, well, the model that we have, I know I didn't talk to you about the details of the model, but the model that we have ultimately delivers predictions about the option price, whether the option price is high or low, option is over or undervalued in terms of the prices. Results that I've shown to you right now are all in terms of the returns of the options. So you might wonder, well, can we check directly the option price, whether it is too high or too low? We can. Obviously, that begs the question of what is the right price of the option to which we will benchmark the actual market price. What's the right price? Well, I don't know. We are going to benchmark it against the usual suspect, which is going to be the Black-Scholes price, right? We can calculate the Black-Scholes price using the estimate of volatility as historical vol or Garch vol and so on. So I'm not claiming, I don't want to overclaim and say that the mispricing that we are measuring here is based on the true price of the option, because I don't know what the true price is. But if I use Black-Scholes as the benchmark, measure the mispricing relative to the benchmark, again run Pharma Macbeth regressions, the coefficient of interest to me is the log stock price, I again find that the options on on high priced stocks are undervalued, right? So the coefficient here is positive. So in some sense, we kind of like this result a little bit, because it goes directly at the heart of our model's predictions and does not maybe, so Neil was concerned about this. I don't know, I can't read into Neil's brain, but maybe he was concerned also about that, hey, we are trading little pennies, so the returns can be inflated or whatever because of the return calculation. Here is not really the return calculation. Here we are really looking at the deviation of the prices from the Black-Scholes price. So maybe I don't know, I don't want to push Neil on agreeing with me, but maybe this might be a little bit better for Neil to digest. Now, a weak part of our paper, which I already want to mention, but you might be thinking, right? So actually, Dimitri, I was a little scared when Dimitri introduced the paper. Dimitri introduced the paper by saying, I'm going to tell you how to make money, right? That's what I think Dimitri said. And I thought, well, I'm not sure that I'm going to tell you guys that how to make money. I'm going to show you something. Whether you can make money or not is not totally clear. Here is why I say that. So here now, this is a table. This is a table in which we are going to look at. So we can look at only the panel B, the impact of transaction costs, right? So right now, for example, I have shown you that my trading strategy makes 58 basis points. The long short portfolio is 58 basis points. These are returns calculated from the bid-ask midpoints and so on. If I impose like reasonable amounts of the effective spreads to quoted spread, which is 10, 25, and 50%, obviously the amount, the magnitude of this return goes down. For example, if the effective spread is 50% of the quoted spread, then this 58 basis points becomes only 17 basis points. Actually, in the case of puts, from 34 basis points I go down to only 5 basis points. So it's not, and you see 5 basis points is economically and statistically insignificant, right? So now, what does that all mean? I don't know. I don't want to oversell it and say, hey, our strategy is making huge amounts of money, which survives any reasonable transaction cost or not. I do want to kind of tell you that, yes, transaction costs are important. How big are the transaction costs in this market? Well, we know that for Dimitri and Neil already have a paper on this. So, they might have their more views on whether the option trading costs are very high or very low. I just want to tell you what the results are, and then you can make up your mind whether this is implementable in real life, how implementable it is in real life or not. I want to get to the economics of this a little bit more. So with having said that, right? So Dimitri, I'm sorry if I disappointed you with the tradability of this strategy, but I'm being frank about what we have and what we don't have. There's a lot of robustness tests in the paper, as usual. We are going to do alternative returns to month end, return to weekend. Right now we do when I said we do delta hedged portfolios to expiration. The positions are created only once at the beginning. After that, we don't daily rebalance deltas. If we do daily rebalancing, does not really matter. We look at subsamples, alternative options, different maturities of the options. Obviously, some numbers change and so on, but the totality of all these robustness tests is that our results are pretty robust to most, if not all, of these alternative schemes or empirical choices. Now, we do so I have like about 20 more minutes, which is fine. So I want to do two things more with you.
Let me jump in and ask Dima's other question before you move on to the natural experiments.
Yeah.
So the question is, I wonder how the main result depends on market-wide investor sentiment. Maybe investors express higher demand for options on low-price stocks when their sentiment is high.
Yeah, good question, Neil. I will be totally frank with you. I don't remember if we have that result already in the subsamples or not. I could check quickly right now, but I will not waste your time or my time to do that. We could certainly, if we don't have it, we can check whether our results are stronger or weaker in times of higher or lower sediment. I think that's a good question to ask. I don't know if you have already done it or not. So apologies to my co-authors who are here if I don't remember all the results of what we have.
So now that I've interrupted you, I'll ask another question. So Tobias has a question.
Is the effect stronger?
Is the effect stronger for stocks with high open interest? You see it, yeah.
You know what? I don't know. So all I have here in like Pharma Macbeth regressions is I have a control for not exactly open interest, but something like open interest, but that's a control. I think what Tobias, you are asking is maybe like an interaction between the stock price and the open interest, whether it's stronger or lower. That I think we don't have, but we can check whether that is the case or not. But we do have a control for something like an open interest in the Pharma Macbeth regressions, and our results are not sensitive to that control. Neil, you were going to still ask me something.
Well, so go back to the model. It seems that part of your story is that limited attention investors are generally buying options rather than writing them.
For low-priced stocks, that's correct. Limited attention investors are generally buying options on low, so using my decile 1, decile 10 somethings. Low limited attention investors are generally buying these options. That's correct. And I will show you evidence for that.
Okay.
I mean, I will have to make some assumptions there, but I will show you evidence for that, that yes, that is the case in the data too, that what we call as, I mean, I'll have a proxy for who limited attention investors are, but those investors we do find in the data that they are indeed buying these options. So that's coming up. That's coming up. Okay. All right. Okay. All right. So let me tell you about these two quasi-natural experiments. Okay, so number one is about stock splits. Stock splits are kind of cute, right? Because well, maybe I'm over speaking, but right. So give me just a little bit of liberty here to finesse some things which might be important but are not actually important for us. The point is, stock split. If a stock splits from $50 to $10, 5-for-1 split. According to our story, because of these limited attention investors, the options on the same stock now, because it is split, should become more expensive. That's what our story says. And we can check this thing in the stock splits data, right? That's what we're going to do. We are going to look at now. The reason why I said is, well, I have to be a little bit careful is because there's a huge literature which says stock splits are not completely devoid of information. Stock prices don't split completely 5:1. There could be information signaling, etc., etc. So we have to devise a test which is agnostic to what is the information content of the stock split on the stock price. Right? My interest is only in the option price. So that's what I'm going to do. I'm going to look at, for example, this post to pre option to stock ratio, which is basically going to be the ratio of post to pre option price divided by post to pre stock price. Right? That's what I'm going to look at. And there's lots of panels here. Sorry, it's a busy table, but I'm going to show you only two things. So let's say in the 3-day window around the split. What these numbers show is that the options on the stocks which experienced the split, the call options, those call options, everything else being equal, became 13% more expensive. Same thing about the put options, they became 9% more expensive. If you're worrying about some timing effect, some moneyness effect, moneyness might have changed, etc., right? So those things could be going on also. We could look at the standardized implied volatility ratios. Even there we see that the implied volatility, a measure of the option price in the 3-day window for the calls, has increased by about 12%, and for the puts has increased about 8%. So to us, this is kind of a cute experiment, which kind of suggests that, hey, these results are being driven by the split. I want to clarify one thing. I hope I will have time. I want to clarify that some people have asked us, well, isn't it the case that around splits, after splits, stock volatility also increases? So if the volatility increases, isn't it obvious that the options also will become more expensive? So, right. So is it that you're just rediscovering that effect? And our answer to that kind of a question is no, not really, for two reasons. First, we are looking at only short windows around the split, right? We are not looking at 1 month before, 1 month after. So either the investors know about this volatility effect. If that's the case, like if you look at the implied volatility, right? Implied volatility is forward looking. That should not change because purely of the volatility effect. Yet we find that to be the changing. So we think it's not the volatility of the underlying changing post split which is driving our results. It really is due to the post split stock price being lower that is driving our results. Okay, that's stock splits. Another, I think, sorry, I'm using this word too many times today. I don't know why, but another, I think, a cute experiment. Sorry, I'll try to not use this word, overuse this word again. What is this experiment? In this experiment, we are going to look at mini index options, right? So I didn't actually know about this thing a lot before, but many of you, I'm sure, knew about this because you work more on options. But there are options on indices which are 1/10 of the regular index. For example, the Nasdaq mini NDX option is 1/10 is an option on 1/10 of the Nasdaq 100 price. Same thing, the options exist on S&P 500 mini index options, right? So there is absolutely no difference between the index and the mini index, except that one of the prices is 1/10 of the other, right? This is not a split. Everything is the same, apart from the fact that one of the underlyings is 1/10 of the other. So we can look at the options on these two things. How are we going to do that? We are just going to multiply the option on the 1/10th mini index by 10 divided by the main index option price. The prior has to be, the null has to be that this price ratio is exactly equal to 1, right? That's what the prior has to be. We look at these options, and these are index options, so one should not be expecting that even if there is a deviation, that deviation is going to be very high. Okay, we don't find the deviation to be very high. Nevertheless, we find that, for example, for the calls, the price deviation from 1 is 1.009, and the t statistic for the difference from the 1 is very high, right? So even for these index options, where again, this is not, again, if somebody wants to ask me whether this is tradable or not, I don't know. We have not really analyzed the tradability of this kind of a strategy, but it kind of is surprising to us that even in these index kind of options, we find a price effect where there is nothing else which could presumably be going on. Neil.
So let me jump in with another question from Tobias.
Yes.
I wonder, can this at least partially be driven by the quoting restriction in, integer, that the quote has an integer multiple of 5 cents? I would assume that a market maker will always round up to his desired price, and that this might be a consequence of this rounding error.
Okay. I'll have to think more about Tobias. I'm just going to make one quick comment. It's not an answer. Just one quick comment is, we do have as a control option bid-ask spread. I don't know if this completely answers Tobias's question or not. I'll have to think. I'm sorry, I'm not being that fast in thinking. So I don't know. But we do have a control for option bid-ask spread. So I will think about this, Tobias. So thank you for asking. Sorry, I can't think that fast. Maybe somebody.
So another related point or something from Che is that the SPX are much more liquid than the XSP. Yeah. So he wonders if this could be, somehow liquidity is priced.
It could be. It could be. We have not. It could be. It could be. You're right that regular SPX options are much more liquid than the options on the mini SPX. I don't know. It could be. But maybe somebody can help me here, and because somebody might know. I was under the impression that even so, the options on the mini index are still pretty liquid. But I don't know. So again, I cannot answer this question whether this could be just a liquidity risk. Again, to come back to one of the things, right? So it's not a liquidity risk per se, but when I was doing the Pharma Macbeth regressions on regular individual options, right? So I have some controls for the option liquidity, and what you do not see here, but is in there under below also is, I also have controls for stock liquidity. So my results, at least for the cross section, are immune to some measures of liquidity. About this particular question that you asked, Che, it could be. I don't know.
So let me pursue this a little more. So,
yeah.
But I'm thinking that the people who make markets in the SPX are the same as the people who make markets in the XSP.
Okay.
Maybe I'm wrong about that. But anyway, so then you're thinking that I'm the market maker who makes markets in both symbols, and that I put a different implied volatility in my valuation model for the XSP than I do for the SPX?
So my answer to that is going to be following the GPP model. Our answer to that is, somehow some option investors are happier, I don't know which word to use, or have excess demand for the XSP options. And the market makers cannot absorb this excess demand because of inadequate hedging. And that's what leads to these option prices on XSP to be higher. That's my answer.
Okay. I'll let you go on and follow up at the end.
Okay. All right. Okay, good. All right. Okay, so I have about 10 more minutes, which is good, which is almost about the time that I need, right? So now, so I have shown you like many of these results about basically the first and the second hypothesis of the paper, which is options on low price stocks are too expensive. Okay, but the ingredient of our story, and Neil already asked me, one of those ingredients is coming from these limited attention investors and the lack of perfect hedging from the market makers, right? So now the question is, can we dig deeper? Who are these limited attention investors? Obviously a question I cannot answer for certainty, but I tend to think that these, in the model, we have also rational investors, right? And these limited attention investors. I tend to think that these limited attention investors are more likely going to be retail investors than institutional investors. Okay. So for the rest of the 2 or 3 tables or whatever, 3 or 4 tables that I'm going to show you in the next 10 minutes, I'm going to equate limited attention investors with retail investors. And here are 3 or 4 things I'm going to show you. I'm going to first show you the question that Neil already asked, that retail investors are going to buy more of the options on low priced stocks. Then I'm going to show you that the option expensiveness, again measured as the deviation from the Black-Scholes price, is going to be actually related to net retail buying. So the elements in my story, right, these investors buy more and that has an impact on the option price. Those 2 elements of the story that I have are going to be kind of seen in the data. In the last 2 tables, I'm going to show you, well, these limited attention investors, I've modeled them as they don't pay enough attention to the stocks. What if the attention increases? If the attention increases, my results should be weaker. That is what I'm going to show you also. And maybe the last thing about the hedging cost, right? So that's the plan for the next 5 or 10 minutes, to dig deeper into the mechanisms of the story and see if I can find or show you some evidence consistent with that, taking some liberties, if you will, as to who are the limited attention investors. All right, so number 1. Okay, so this is it's actually a complicated table and so on, but let me explain to you what we are trying to do. So we are going to use the ISC data, right? So that I'm sure all of you know. So we are going to look at the retail net buy from the ISC data. We are going to run a Pharma Macbeth. We are going to look at the net buy, total net buy, retail net buy, and professional net buy. We are going to run this as the dependent variable on the independent variables, which are a host of variables. But the interest for me is right now on the independent variable, which is the price. This table only shows you the coefficient on the price. Okay, so let me look at just these 3 numbers for a second. Okay, so the coefficient on the price for the retail net buys is negative, right? What does that tell me? That means that these retail investors are buying less of options on higher stock prices. They are buying more of options on lower stock prices. So this is what Neil had asked me earlier. Well, that's one of the elements of the story, and I had promised him that I will show him that. This is one piece of evidence here. For professional investors, we don't find any such effect. Okay, so if you grant me that these retail investors are more likely going to be, how do we define retail net investors, Pedro? This is from the ISC data. I think ISC classifies the investors based on retail and or institutional. So we just follow their classification. Right, so that's all we do. It's not more fancy than. So this is coming from the ISC data, right, which classifies these as retail or institutional. Okay, so that's how we do it, Pedro. Okay, all right. So that's number 1 element of the story. Are the limited attention investors buying more of options on the low price stocks? Answer is yes, they are. Second, okay, they're buying more, but is it creating expensiveness of those options? Like our results, we know already, I've shown you already that those options are expensive. But is the expensiveness related to this extra demand from these retail investors? I have not quite established that. That's going to be what I'm going to do here. Okay, so this is as you can see, I'm very grateful to Neil for inviting me to present at this forum, at this workshop. I'm not trying to kiss ass or something, but I mean, of the few papers that I'm citing in this, well, Neil obviously figures prominently. But anyway, so sorry for the tangent, whatever. So I'm going to use they have a new paper in which they look at the option buying and so on. So I'm going to basically calculate the net demand following their approach from the retail and the institutional investors. That's going to be my independent variable. The dependent variable is going to be option expensiveness, right? So this is what I want to see, whether the retail demand has an effect on the option expensiveness. Option expensiveness, as before, defined as the deviation from the Black-Scholes price. And again, this is what I find in decile 1, for example. In decile 1, I find that the extra demand, as calculated following the previous slide, of retail investors is positively related to the option expensiveness. That's the second element of my story, which this table documents. All right. Number 3. My result is inattention causes all the action kind of comes from inattention. What if there was no inattention? What if there were events, periods in which the attention was higher? Inattention was lower, attention was higher. Should I not expect to see my lower results? Neil already asked me this question about the investor sentiment, to which I pleaded ignorance whether we have done that or not. But here is something that we have done. So there are, number one thing, we look at earnings announcement days. Scott asked, how do I distinguish limited attention from leverage constraints? I don't know, Scott. I'll have to think. Scott, as to what that is. Let me finish up, because I know Dimitri has fingers on his thing. He's going to start sounding the buzzers. Let me finish some of the 3 or 4 slides, and then maybe I'll come back to you, Scott, and then we can think maybe together about your question. Okay. All right. Okay. So about attention. So this is what I was saying. So earnings announcements obviously are salient events, right? There's a lot of attention around earnings announcements. So in our story, it is hard for us to argue that even around earnings announcement, these limited attention investors are not paying attention to those stocks. Well, they are in the earnings, right? So, I mean, you really have to be sleeping a lot for you not to pay attention during those events. So bottom line, we expect our results to be weaker around earnings announcement days. So how do we test for that? Again, Pharma Macbeth regressions. I'm just going to have a dummy for the earnings announcement days and the interaction of the log stock price with the earnings announcement days. And since I'm showing you the results, it's not really a surprise. I do find that those results are weaker around earnings announcement days, during the days around which we expect attention to be higher, inattention to be lower. Okay, so that was, in some sense, I don't know how to call it. You can think of that as some kind of a time series kind of a test, even though it's Pharma Macbeth regressions, as some kind of a time series test. Here is a purer, if you will, cross-sectional test. Are there some stocks which are more in the news, have more attention, and some stocks which have less attention by the retail investors? Now, I don't know how exactly to calculate the retail investors' attention, except by using, for example, Google Trends. So here, Google Trends, this Goog variable that we have is going to be a dummy variable, which is one for stocks which have a lot of Google Trend. So basically, is our proxy for stocks which have a lot of attention, and that's the dummy variable. Again, I'm expecting to see, if I interact that with the stock price, my results will be weaker, because the more attention is there to a stock, the mispricing that we are talking about should be weaker. And indeed, we find that that's the case, both for calls as well as for puts. I know I'm almost out of time, Dimitri. 2 or 3 more minutes, if you will permit me, and I will finish. Okay. All right. In fact, this is probably the last table that I'm going to show you. So I'm going to be done really soon. Okay. The last part is about, well, there's there's two actors in the drama. One is these limited attention investors, the other are these market makers, right? And like in GPP, the reason why some of this is happening is because the market makers cannot hedge costlessly, and these hedging costs create the scope for demand pressure. What if the hedging costs were lower? If the hedging costs were lower, well, obviously we expect to see lower effects. What are these hedging costs, right? So now we have a few proxies for these hedging costs, three of them actually: stock spread, stock illiquidity, and idiosyncratic volatility. So what we do in this table is we again sort stocks based on, it's a double sort. It's based on, the first sort is based on our hedging proxy, and the second sort is based again on the stock price. And I'm just going to show you the long short portfolio alphas for different quintiles, right? So these are the ones for which the hedging cost, quintile 1 is for where the hedging cost is low. Q5 is the portfolio for which the hedging cost is high. So what we expect to see is the action is happening here and not much action is happening in quartile 1. And that's basically what we see in this table, that actually most of the action, if you will, is not happening neither in quartile 1, nor in quartile 2 or quartile 3. Most of the action really is happening when the hedging costs are high in quartile 5. So again, something which is consistent with the fourth hypothesis from our model. Okay, sorry, I misspoke, Dimitri. One more minute. I apologize. I forgot about this. This is an important thing, so I want to spend just one more minute on this. People have asked us, well, low-priced stocks and low-priced options, maybe they have higher skewness and so on. So could it be just a skewness preferences? There's other literature in the stocks also which has documented preference for lottery-like stocks and so on. So that could translate into preference for options on such stocks. So it's not really about limited attention, it's about skewness preference. We don't think that's the case because we actually calculate the skewness of the options, the portfolio of options in decile 1 and decile 10. And as you can kind of see, if anything, the skewness is higher for decile 10 than for decile 1. A skewness preference story would have required higher skewness for decile 1, which would have generated all the results. We don't find that to be the case in our data. We also, as I've shown you, we do double sorts using skewness proxies. We find evidence for both calls and puts, and indexes and mini indexes have the same skewness, right? They are basically the same thing. So we don't believe that skewness is really the thing which is driving our results. All right, so the final slide, which is, what do? We document that options on securities with low prices tend to be relatively overpriced. Okay, we argue this is because of inattention to the underlying price by some investors. We call those as limited attention investors in the model. We tend to think of them as retail investors. We find lots of evidence which supports model predictions and kind of the alternative mechanisms we believe do not completely explain our results. Okay, so that's it for me. I am 3 minutes over time that I was told, but I hope it is okay. So thank you all. I'm open for feedback and questions, please.
So plus or minus 3 minutes certainly counts as on time. So at this point, anyone, we'd like to invite anyone to unmute yourself and use your microphone to ask questions. Anyone?
Yes, Professor. I have a question, sir.
Yes, hi.
I'm from Mumbai. I wanted to know whether this kind of study can be replicated to masala bonds or masala stocks, something like that.
I don't know what those are, Anil, so I cannot really reply to you. But if they are kind of, I don't know what they are, but if they are kind of things which look like options, have option-like characteristics, I would think, sure. I mean, the idea that we have is basically this inattention to the underlying price has an influence on derivatives on that asset. So if these bonds that you're talking about share those characteristics, I believe, sure, why not?
Just a quick question, bringing us back to the discussion you had with Neil and following the questions from Tobias and Che. So you brought us back to the model, right? When you talked about, there is more demand for these options, but in the end, the empirics at that point was based on option metrics, right? So these are quotes, not prices.
Yes.
And what I'm wondering is, so are the options, so is, maybe it goes back to is there a different effective spread on those options than on more expensive option?
I see. I'm going to quickly look if I can find some numbers for you.
Because the midpoint might look expensive, but it doesn't mean that the options are traded at that midpoint, right?
So let me, if I can, let me share screen again, Christian, and because I have some numbers I can show you. I don't know if they go along with what you're thinking or not, but here is, sorry, I apologize. Here is the option bid-ask spread that I have for decile 1 versus decile 10. So I think it's not a surprise that for decile 1, the bid-ask spread is higher than decile 10. Does that help or hurt our story? I'm not sure I understood.
So so what I wonder is, if I'm going to post a limit order somewhere within the spread,
yes,
will I do it at the midpoint if the spread is very large? If the spread is very narrow, then I might not even have the possibility of going elsewhere, right? But if the spread is very large, maybe I can be closer, to one end or the other, right? So which means I'm probably not going to pay the midpoint. So if I'm, and it's kind of, so it feels like you have a lot of circumstantial evidence, but I'm still kind of looking for the body. So it's, I'd like to be sure that the options are really traded at too expensive price.
So can I rephrase your question to one of the weaknesses that I already talked about in the paper is, if I look at the table in which I had transaction costs, in which I was not trading at the midpoint, but I was trading at whatever 10%, 25%, or 50%, that would be that. If I had strong results, let's say even at the 50%, that would be satisfactory for you. Do I understand correctly?
Well, actually, one way to satisfy me would be to answer to Dima. So if you can actually make money out of this, then there's, assuming that you pay the full round trips and everything, then there is a mispricing, right? But otherwise, if you cannot arbitrage it away.
Yeah, full round trips, I can already tell you. Full round trip, if we pay full round trip, we are not going to be making any money, right? That's clearly the case. Now, if we pay 50%, we can make some money. So I don't know what Dimitri says as to what is a reasonable number to think of.
I mean, you guys holding those until expiration, so presumably you're only paying half of the cost. That's my understanding, right?
Correct.
Or maybe less than that if you are skilled.
Correct. So right. So Christian, so whether we make money, I guess a little bit is how I would say it.
Good. So I won't quit my day job.
Yeah.
Can I return to Neil's comment about this index options versus mini options? I'm wondering how market makers are managing inventory for those. So if I'm a Citadel and I get order imbalance in SPX options versus order imbalance in those mini options, will I delta hedge them kind of jointly, or like what would be your implications for the story depending on how market makers actually manage inventory for those?
Yeah, so I guess if
obviously
it does not matter. I'm going to say something. I'm not sure whether that will be completely right or not. Please tell me if I'm making a fool of myself. Even if whatever they're going to do to hedge the underlying is whatever, the underlying is the same. Because there is excess demand for the mini options, I'm thinking that kind of following the GPP model, because of the lack of perfect hedging, that will create a price impact on the.
No, but the question is whether they manage the regular index options and the E-mini options as a single book, right? So that excess demand for one, right? Do they manage them as an integrated book? And does excess demand for one affect the price of only one, or does it affect the price? It really comes down to my question: do they have the same implied vols for the two options that are of different sizes?
Yeah. So yeah, I think I don't think I have good answer to that. Yeah, I don't know. I'll have to think a little bit more. If you don't mind, Neil and Dimitri, I may come back to you later once I have thought more to get some clarifications, because yeah, I think I'll have to, the reason why I'm not completely sure is because I think I have to dig deeper into the GPP model and our model and try to see what would happen in this kind of a context as to what is it that I'm implicitly assuming in the GPP model and whether that's more realistic or not. But thank you for asking the question and making me think. I don't think I have an answer right now.
Another quick point here is I really like your Google Trends result. Another alternative would be there is this recent GF paper which helps you identify retail order flow, right? I think it's like Charles Jones and his co-authors. So in recent data, they identify what percentage of the underlying stock order flow is retail because it's internalized. So it's not going back to 1996, but that may be like one data set that you may have in mind once you get like an R&R or something and want to expand on those results.
So your idea that, thank you very much for that suggestion, just to understand. So you're going to say that stocks for which there is a higher retail order flow would be the ones which are more in the new, which are more, investors are more attentive to that. So we should find weaker results for that. That's the hypothesis.
I would just view it as a measure of alternative for like attention. Yeah. So maybe like interacting with the stock price or something.
Yep. Thank you. I will look in this paper. Thank you. Thank you, Dimitri, for the suggestion.
Amit, also related to what Dimitri said, you can look at Robinhood data.
Okay.
It seems also that in Reddit and all these places, they talk a lot about penny stocks and also related to options. That was another question.
What's this data, Pedro? Sorry, I missed it.
Robinhood data.
Robinhood data. I see. Robinhood data. Okay.
Small period, but you can get something out of it. And I think there is a lot of demand for these penny stocks.
I see.
My question is more about the intuition, because this is what I was reading like recently, that now, for example, some investors, as they cannot buy very expensive stocks because the price is very high, they tend to buy the options. What I was thinking about is like how these investors, it's very cheap, no? These options, they are $5, $1.
Correct.
How do they buy options instead of buying the underlying?
So let me understand, Pedro, are you trying, is the idea that you have is it's easier for these guys to buy options on low priced stocks than it is for them to buy options on high priced stocks? It's just ease of buying. Is that the idea?
Yeah, maybe. I don't have an answer for this, but I was thinking if that might be the case also.
Yeah, let me rephrase this question. So what I was thinking, your results are actually interesting because my prior would be different, because I don't have enough money to buy a Tesla stock. It's $1,000, but I always have enough money to buy a call option, a weekly call option on Tesla. And that would say, hey, there will be some effect for options on high price stocks, and you find it on low price stocks, which actually makes it kind of interesting because it goes against those kind of news article in my prior about that high price stocks will be more important than low price stock.
Yeah. So this constraint on the amount of money that I can bring to the investment would imply a different opposite result of what we find. And I think Che just said also something which is about this leverage constraint. I think that's the similar idea, right, Che? That's what you're thinking of, maybe in response to what Scott had asked me earlier.
Yeah, I think the leverage constraint would completely predict the opposite.
Yeah, because that leverage constraint is similar idea to what Dimitri just said, right? So these are
I'm now curious with the question that Dima and Neil asked regarding who are the market makers of SPX versus XSP, and curious to see how much of these, how much of the contribution of our market, like, is there a big, I think that the demand side on the XSP might be more binding. So it could be that most of the market clearing happens for the main SPX. You see the supply side intermediaries have to do a lot of buying and selling option, to hedge. So you see that the firm probably do a lot of more involvement, while the XSP, I think that the market clearing would be more, I would say, like, less imbalanced. And I think I'm not really clear with this, but I think it has to do with more like demand supply shock with the intermediary that make the two SPS and XSP different.
Yeah, so I think that's the question which Neil and Dimitri asked, whether these guys is the same market makers or not, and even if they are the same, are they managing this book as an integrated book or a separate book? I think that's the question. That's at the heart of the question. And I don't know as to what happens in real life. And I think I have to also think about, which is what I said to Neil earlier, as to I have to think about what is it that I need to assume for this result to work out in my model.
And one last thing I'm curious is that when you're buying an option chain, when you see a quote online, if you're a retail investor, the price of the underlying is listed next to the option price together with all the possible moneyness.
Yeah.
So it's, to me, I'm trying to think from the institutional standpoint is how can you not see the price of the underlying simultaneously with the price of the option?
Yeah, I think that's a good point. And I think we have kind of thought of that. And, I'm going to give you a weak maybe answer. It's a story that I'm telling you, and you don't have to buy the story.